Here we are
And
again.
here we are again. Welcome back to Crypto Talks, guys. I see people waiting. We got Golden Goose and Imre hanging out, doing. Imre, that smiley thing you're trying to do or emote, it doesn't. It just shows up as text here for us, but I'm sure it's a great smiley face.
Yeah, it looks great. Something
Perfect.
to hang out.
Oh wait, yeah, you're right. Cool. Yeah. So we're doing a new thing today. Well, not really a new thing, but we're dedicating an actual live show to some macro stuff. And yeah, we'll see how it goes. Finally, we can just do just macro. We used to do these long 2-hour things before. I think we'll keep this one under an hour at least.
Ish.
And we'll see. Hey, Badger. But yeah, let's dig into this because we're gonna be looking at we're gonna take a look at the CPI, the current numbers, the trend. We're gonna look at the core CPI. Same thing there. We're gonna look at the most recent GDP for the US, which came out really high, and I think Rob has a great explanation for that, but we'll get to it soon.
I don't. Yeah,
Well,
that might be a bit of an underwhelming explanation.
Don't
Don't go overselling it.
Come on. No, but so yeah, we're gonna look over all that kind of macro stuff. Maybe look at some statistics while we're on the site and all that, and see what we can figure out. I know Rob has prepared a couple of charts, as he does.
Yes, I do.
And Imre says, "I just did buy some more Bitcoin." Oh yeah, nice.
Good.
Buying Bitcoin is never wrong. All right, cool. Let's see. I'm gonna jump over directly to this. Okay, so let's start with the inflation rate of the United States. And this is something we followed a lot before for you guys who were watching us months and months ago when it was more of a hot topic. And we were always talking about how this, actually, I might zoom in here. The trend is down from the peak, obviously, and we predicted very beautifully that once we got to a year over year from the peak, we would have a bottom. And right here we did. So inflation has been up and then sideways. So we had a print of 3.7 twice in a row. And the Fed has been pausing rate hikes now for, 3 months? 2 months? 3 months?
Yeah, well, I think two meetings. I think they didn't.
2 meetings, yes.
I've got a feeling that, yeah.
Yeah, and
I
think our prediction for this next meeting, which is on the 12th, I think, of November, there will be another pause. Potentially, actually, it's not going to be a cut, but I can actually envision a rate hike of 25 basis points. But I doubt it. I doubt it.
Don't think they have the balls.
I don't think they have the balls either, because
I think
a secondary thing to that is that they usually look at the core CPI, which is down, right? So that is what they are more interested in.
Yes.
And it's been going down heavily. So there's that, right? And I don't envision them actually, raising the rates again now that they paused it. It would be a bad look.
I don't know what they think a bad look is. I don't think they ever. We've talked about this like quite a few times, but if we're introducing sort of the macro aspect to this, is that on a big picture basis, these continuous rate hikes have put a really, really high amount of excessive amount of pressure on everything, on global debt, because you've got to remember that there's so much global debt which is priced in dollars, and if you can go out and you can get 4.5%, 5% interest on US government bonds, then suddenly the amount of capital you need to the amount of capital, the amount of interest rate that you need to charge for foreign bonds, for foreign corporate bonds, for mortgages, for things that have orders of magnitude higher risk. Because if US government bonds fail, then the whole global financial system fails. There's no happy ending to that. So US government bonds, sorry to people who think that the dollar's going to collapse tomorrow. The dollar is not going to collapse from a position of weakness. Government, if you can get 5% on government bonds, you need 6% on euro bonds, you need 6.5% on Great British pound bonds, you need 7% on Chinese bonds. And one great example of this is the yen, where Japan have continuously held their interest rate they've tried to hold their 30-year interest rate at 0.25% for this throughout this entire time, because they've had this long-term policy of QE, and the yen has absolutely collapsed as a result of this. Because if you can get 5% on dollars and 0% on yen, effectively, why would you hold yen?
Right.
You're just not going to. Yeah, it's just so the yen has sold off, and so for other countries to maintain the value of their currency versus the dollar, they have to offer higher interest rates in their own currency, if they even have access to their own currency, or they need to service their dollar debt, and if they can't pay it off, they have to refinance at higher interest rates, and these higher interest rates need to be repaid in dollars. So the country then has to sell off its own financial reserves or its own currency to obtain the dollars to pay the interest, and guess what? The system is then completely starved of dollars, and this is what the effect of financial tightening is. This is what financial tightening means. It is a reduction in the quantitative easing is when you're increasing the base money supply, you're increasing the amount of money available. We are not going through that. We're going through a period of financial tightening, a reduction of money, and there is not enough dollars available in the world. And if you think that as well, the fact that a lot of these US bonds, the effect of rising interest rates has been a complete and total collapse of bond prices. It's probably worth us just getting the chart up.
Yeah, for sure.
I'll just so I'll just put up TLT. TLT being move indicators. So TLT is the US 20-year Treasury bond, and these are monthly candles. So this chart goes all the way back here to 2003, and so the price of this bond has been increasing throughout all of the 2000s and then you see 2019, 2020, it went vertical, and just so happened that was when we had the COVID crash, put interest rates to zero, and as a result of us then continually hiking, these bonds have sold off, and they are now sitting at 20-year lows. Like this is a 20-year bond, and it's at a 20-year low. And if you just add on,
so I mean,
rate,
yeah, exactly.
And if I just invert this, you can kind of see what happened there.
Yeah, and the Fed funds rates, for everybody who doesn't know, is basically the interest rates, sort of.
Yeah,
it translates into that.
It does. Yeah. So this is the target interest rate for basically the US dollar, and so during this ridiculous period that we call the 2010s, where they decided to just hold interest rates at zero, this is what builds financial bubbles, because say the interest rate was basically zero, and so you couldn't make much money off bonds, and nevertheless the price of bonds continued to rise, but the yield on them, the amount of money that they actually paid in the background, was zero, essentially. And so you have this issue where we're now in this high debt, high interest environment, and we've got this really strange situation now where all of this debt has to now be serviced, and it's going to have to be serviced at 5.25% interest rates, and that's a hell of a lot of money that suddenly has to be found. And where does that money come from? It comes out of the budget, it comes out of taxes, it comes out of growth. And so therefore you've got to think, are these interest rates sustainable long term before they have to ease back and they have to cut?
I mean, like, we can simplify this situation just slightly, I think, for just the general population, because this is normally not stuff that a lot of people think about in their daily lives. They kind of just and a lot of investors don't think about it either. Especially, I'm not bashing crypto investors, I am one, but you tend to get stuck in the crypto bubble and you don't really think much about the rest of the world. So this is beyond
the normie. It's beyond sort of normie knowledge, and this is what people sort of have to understand, is that these are the big picture financial forces that drive the world.
So if I was to just simplify super quick, when the Fed keeps interest rates at 0%, basically, where it's super cheap for people to borrow money because the down payments on everything is super cheap. That means people want to buy things. They will borrow to buy a car, to buy a house. The prices of cars and houses go up because people can offer more for it, right? So on and so forth. You get GDP growth, right? You get GDP growth, and eventually you get a lot of inflation.
That is inflation.
Exactly, and that's inflation. So you get, and then after a while, it's a very lagging thing, but eventually people start noticing it, but not until the Fed starts raising the rates, because they want to slow the inflation down, right? Less money coming into the market from people borrowing money, less things are being bought, less sales, less retail, less GDP growth. And eventually they notice, oops, the whole world is collapsing because nobody can afford to pay for anything anymore. We need to lower the rates, which is where we are kind of right now. And at the same time,
they haven't worked out yet, or haven't had the confirmation yet that nobody can afford to pay for anything.
Yes, they haven't really seen an absolute giga crash yet, which is the crash that we keep talking about, where we're like, yeah, things can go up for Bitcoin and all these things, but then suddenly we can have this giga dump. Things will break. Something will break. So something I wanted to bring up here, where is it? Here's the GDP growth. This is something that I reacted to myself. And as you know, what I just said, low rates, GDP growth. High rates, GDP crash, sort of. That's very simplified, right? But suddenly we're looking at this 2.7. This is July of 2022. So this is quarterly numbers. So we're looking at 2.7 GDP growth, 2.6, 2.2, 2.1. Remember, this is during the downtrend and during the bottom of the bear market. For those in Bitcoin, you know what that looks like. Big downtrend, big ouchie in the wallet, and then a flat bottom, and then you go up. Right now, we've had a jump from 2.1 to 4.9 in GDP growth, while the interest rates are hugely over the top. That's weird to me. Rob, please tell me why this is happening.
So, I mean, okay. So first of all, if you look at the bars there, and you can see there's jankiness to it. 6.2 to 3.3 to 7.
Yeah.
I mean, really?
Precisely.
Okay. So like that, that doesn't particularly make much sense in itself anyway. If you were going to think, oh yeah, the aggregate of a country should be fairly stable, more stable than this. But no, you can see the variation. So I wouldn't worry too much. I'll put it back on the bars. The bars.
Yeah, I was just gonna say, COVID crash.
Yeah.
After COVID, because rates go back to zero. So
you see, it's been fairly consistent. It dipped into recession. It did. They turned around and said, "Oh yeah, no, we're not got a recession," and then since then, we've returned to growth. Now, the this is one of these things with the US, and where where things get complicated is as part of, as we talked about, the global system is the dollar system. The US is a safe haven by just by its very nature, by its existence as the largest market in the world, as the owner and administrator of the dollar. Money, when it goes out of other currencies, when it goes out of other assets, where is the safe haven? The safe haven is in the dollar. The safe haven is where most global trade is enacted. It's where most if you're going to store money globally, you store it in the dollar, and as a proxy to that, dollar assets go up. In the same way that investing in, as the crypto market, as Bitcoin goes up, the rest of the crypto market follows along with it. You put money into the dollar, you put money into US bonds, you put money into US stocks. The whole system is a beneficiary of this inflow of capital, and that's what that's kind of what we see is you see these why stocks can, and you see it every time with stocks. It's a really easy trend to show. I'll just stick my chart on.
Yeah. You put the recession indicator on too.
So let's just put US recession indicator. So it's probably easier if I put on the line chart and switch it to the weekly. So, where's my recessions gone? There it is. So you see you see where these recessions happen, and the one that we obviously most remember is sort of the COVID crash, which was very, very rapid. But you see quite often, and you see there are periods where the whole world wasn't very good there. That was quite close to a bit of a recession. But you see the US is just sort of takes a long time to sort of turn the boat around. This is August 99 to April 2021. This is a 2-year period where it just sort of didn't really go anywhere. And as it stands, we've had a lower high. So until it could even break to new all-time highs and then turn around and roll over. Do we think that we are completely immune to a move like this now?
Yeah, and we haven't even seen the recession officially.
Yes, that's
announced.
It. There's no,
right?
There isn't, and it's one of those things where you can see that the stress is being put into the system, and eventually something's got to break, or you have to take the stress off, and taking the stress off is it's lowering interest rates, because eventually, there's what we've seen. If you talk about we've seen it in countries like Sri Lanka, countries like Pakistan, where they've had these countries have had almost total economic collapses, where they basically the problem that they faced was they ran out of dollars, they ran out of foreign currency, and so because of that they couldn't buy food, they couldn't buy oil. Sri Lanka ran out of, basically completely depleted all of its reserves just by Bitcoin.
You're not wrong, Imre. Kind of.
No, and this
depends on your own time preference. That's what it is.
I mean, if you've got the time preference of a country like El Salvador do, then I'm sure you're quite happy to just buy Bitcoin. But it's the problem. The problem with just buying Bitcoin still comes, and it's as true for a country as it is for an individual. How can you buy Bitcoin if you can't afford to pay your bills? And the reality for a lot of people out there right now, does it feel bullish? Does it feel like all-time high territory out there?
No.
Do you if we look back to 2020, 2021, how much money sort of people had? Not everyone. A lot of people were really obviously doing incredibly rough during COVID, but for people who had jobs during COVID, it was like, oh shit, I've got nothing to spend my money on. Let's buy Dogecoin. And so does it feel like that now, where we've got just money sloshing around to spare?
Right. Look, like Imre said right here, my bank won't give me a loan. Precisely. They're tightening the, it's harder for people to get a loan now. It's just part of the process.
Let's just put that straight into perspective. You're struggling to get a loan, and so we can apply that to everyone in the country on the whole. As an aggregate person in a normal person in a normal country, it is now more difficult to get a loan. It is more difficult to access credit, and the credit that you can access comes with higher interest rates attached.
Mm-hmm.
So that means that now the £200,000, euro, dollar house that you were going to buy, where you were going to borrow 150,000. All of a sudden, now that 150,000, your repayments are now 1,000 a month in interest.
Yeah.
Oh dear, the entire mortgage was only 800 before. Okay, I can no longer afford that house, and so the marginal affordability of the average person can no longer afford what they could afford before. Credit cards, they suddenly stop getting. This is exactly what I found happened to me. Is that I had my credit cards, all the 0% offers dried up. Nobody was offering me 0%, so I'm like, oh dear, I need to maybe now actually pay this for the first time in several years, because before then it was in this world of easy money. Yep, 0%, I'll just roll it over, worry about it in 24 months time. Nope. Dried up. And so if this continues, this is continuing to happen. This isn't showing any signs of returning. So yeah, I want to buy a new car. No bank wants to give me a loan because they said I don't have a lot of money left. Exactly.
So, that is the whole point.
So
if you're really summarizes it. It's like,
if you're a car manufacturer and you have made a habit of selling cars on finance, and so because of that, you've managed to allow a lot of inefficiencies to creep into your car design because, well, it didn't matter because we were selling units at a decent markup. Mm-hmm. And all of a sudden, you now can't sell your car at that price because people can't get a loan for it. Imre, you are the average person. Well, go you. It's like this. You can't help it. It's completely out of your control that now suddenly you can no longer have access to the same quality of goods as you could before.
Yeah.
And therefore you cannot buy. If you can't buy them, that is a reduction in your economic capacity. That is at this point, this is the point where people stop taking out new credit because they can't, and they start going, oh shit, I don't want to pay 18% interest for my credit card. I'm now going to pay it off. You see a reduction in credit. You see the credit being paid back. And that by definition is destruction of money and a reduction of the money supply.
So allow me to just put you into the brain of a bank, right? So what Golden Goose says here, he says, yeah, it's a totally different story. Your salary doesn't collateralize the payment on finance.
But it kind of does.
Hang on. Yeah, yes.
It does.
Yeah, I'm getting to it. So, and Imre says, stupid Europeans. Yeah, it's not really. That's not really true because, so what's happened? I put some of my loans into one big one recently, just to kind of free up a couple of $100 or whatever, but a month, making it cheaper per month. So the way that when I talk to all the banks and what they say is basically, yeah, the interest rate on this car is 5.5%, which is very low, right? Because I got a locked rate from my friend's dealership who partnered with whatever, but it's still a lot more. Normally around in Sweden it's about 9 now, but when the banks look at it, they add on the interest rate basically plus the current, whatever they set, the central bank set in Sweden. So they add like 5% extra. Yeah. So they add an extra one, and then they say, this is, for us in our eyes, this 9% loan is actually 15 in our eyes, right? Something like that. And when you try to get a loan and they look at it and they say, okay, everything looks like crap right now, everywhere. And maybe you can afford this now, sort of, but they can't. Can you afford it in 2 years? Do we know that you can? Not really. do we think that the house you're going to buy or a car you're going to buy is going to go up in value over that course, that time? Probably not. So they can't really take your car and sell it and make the money back. So it's very like they're making sure that they're not borrowing money that they can't take back.
So
essentially,
yeah, there's also, you've got to think how banks make money and how they do it. So if you take out, when you go to the bank and you say, I want to buy I want to buy a house, and they go, okay, yes, cool, you can have $200,000. Great, I can have $200,000, and they just create $200,000 out of thin air.
Yep.
And they basically debit your account and go, there you go, you owe that much, and they give it to someone else and go, there you go, I'm giving you that much, and now your liability has now become their asset, and poof, new money has just magically been created because a new loan was just created. And so the bank, but in doing so, the bank hasn't actually moved anything or doesn't own anything. They just own, basically, they're just an intermediary that sat between and just created money, created a debit of your account and a credit on someone else's account. And that debit now sits with their account. So if you don't pay, they then now owe that debit. They just take on that debit. And so in doing so, all they want to know is, they know that there's a certain failure rate of mortgages. And as long as they have enough collateral, if they have enough assets that back the loans they have, i.e. there's enough loan to value behind the mortgage that they're borrowing against, and then it's fine, they can afford that debit. And now when house prices are going up, exactly the same as we saw before the great financial crisis in 2008, house prices are increasing. Banks are very, very happy to keep writing out those loans, because the collateral, the house that they're borrowing against, that big negative sits against, it keeps going up in value. This becomes a problem when house prices stop going up in value, and when they even start decreasing in value. And when do they start decreasing in value? When the marginal buyer, when the average buyer, if you look at what house they could afford 2 years ago and what house they can afford now, it's suddenly house prices are significantly overvalued. And as an addition to that, all other markets are, a lot of other markets are significantly overvalued and need to reset. The car market, people, I don't know if you can find it, how fast you can find it. Automobile, basically delinquency rates. I wonder how quickly.
Yeah, I don't know if we can. I don't know if they have it here. But actually, I kind of want to stumble over to the point you were looking at making later on with, whoops. Okay, I don't know why that opened. But we were talking earlier about the student loans, right?
Yeah.
Which I feel is
I have this up
going to make a good dent in people's ability to pay their loans,
put my
or
screen
to
up.
have money to spend. Yeah, there we go. Yes.
Yeah. So basically, it is. So yeah, March 2020, they provided temporary relief for student loans. And reduced all the interest rates to 0%. So that was 3.5 years ago now, where people effectively haven't had to pay their student loans, and they are now restarting as of last October, an on-ramp to repayment. And this is, as of June 2023, 43.6 million individuals held a combined federal loan debt of $1.64 trillion, an average of $38,000 per borrower. That is something which is, 43 million Americans that each owe an average of $38,000. That now has to start being repaid over the next year. numbers I've seen is that this is going to be an average of somewhere around sort of $300 to $400 on average per household. How badly would that hit you? An additional $300 a month bill?
Yeah, that wouldn't be fun.
I find it, if you're already stretched, and when you talk about all of these, just these marginal reductions in affordability, the fact that inflation has made the average shop more expensive, the average car trip more expensive, everything as a result of getting more expensive means people are utilizing credit still, whilst borrowing costs are at record highs. And when you start slapping on additional repayments onto those already squeezed margins, and the longer these interest rates are held, the more people are forced to refinance at higher and higher rates, the more this interest debt piles up, and it can really become a burden. And at that point, that is where you see really, really drastic cuts in consumption. And by definition, if you reduce consumption, that's a recession.
Yep.
That's what happens. That is, and at this point, it's so inevitable, it's laughable. The problem is it can be delayed. They could even they could cancel the whole recession tomorrow if they just go, interest rates are going back to zero. Fuck it, easy money for the next 10 years. Let's go.
Yeah.
I mean,
but
that
then
would bring
we have massive inflation and et cetera, et cetera. I was watching a video the other day from a creator on YouTube that I can't remember the name of him. It's great. I like to watch him. He's good. But he brings up a lot of these data points and kind of gives a rundown. But he had a little bit of a prediction where but I agree with most of it, but he says, we'll have a pause here again, and then let's say in Q1 somewhere we start dumping the rates again slowly. Let's say they do it slowly, 25 basis points per month. That would be slow in reference to like how fast it went up. But with that, his prediction was that we would have a surge of inflation in 2025, which basically also translates into rates go down, global liquidity goes up, everybody who's in assets like Bitcoin and whatever, I'm just using an example, will do really well, because that means people will have money to put into assets. And that means assets go up. We have a Bitcoin ETF coming. Not sure what that's gonna do. Directly when it's out and everything. But so
it can fuel a narrative.
It's like we can have a huge bull run 2025, right? We can.
Yeah.
But then we get that, this is like the run up to the whole actual giga dump.
I mean,
it could be the thing, yeah.
It's a lot easier. It's a lot easier for things to dump from high up. It's a lot to push Bitcoin 70% down now. You're talking about getting all the way back down to sort of the lows of last year, or the start of the year. Well, last year, wasn't it? And that's a very, very tall order. It's certainly possible. If you look, if we just go back to 2020, that is basically exactly what happened. It just flipped over and did a dive bombed. I do think something, maybe not so fast and drastic, but something along those lines is primed to happen again, and it's going to be, it's probably not going to be a complete dive bomb, but it could be several quite rapid dive bombs, and I think it'll affect everything, and Bitcoin will not be immune from it. Afterwards, this is the thing. After that, then great, up only forever. We're all millionaires. Sure. But
why not? But being a millionaire in 10 years is not going to be the same thing as being a millionaire now, because inflation.
Inflation is one of those tricky things. It's it's strange. You've got the core is still coming down, whilst the the CPI is still is
Stuck.
as stuck.
Sticky.
Yeah,
We got
but
sticky inflation right
if you
now.
look what's sticky is as we talked about house prices. Houses are very, very sticky. They don't come down because you can't buy a house tomorrow. You can buy a car. I can go out and buy a car tomorrow if I want to. I can't buy a house tomorrow. So when you see that people takes a long time to decide how much a house is worth. The market is always trying to be forward looking, but you can't be forward looking when it takes 6 months to sell something. And so what we have is if you think about what's happening to the housing market, is all of these, because of these much higher affordability requirements, is the amount of people making mortgage applications has absolutely collapsed. It's completely dried up. And so you have a lot of people that have got the house on the market and there's no bidder for them. They can put it on saying, oh yeah, it's worth $250,000, it's worth $500,000, it's worth 750,000. It's only worth what somebody's going to pay for it. And I always joke to say with crypto people is that the housing market, it's an NFT market. Houses are NFTs, and you can turn around and go, look how much I paid for this. This is what this is worth. No, it's worth what somebody is willing to pay for it. And it can take a long time for sellers to realize, oh dear, nobody's interested in my house at what I thought it was worth. And similarly, oh dear, my interest rate is now going up to 6.5%. And oh dear, I've got $300 student loan payments coming up. Oh dear, I've also got continually rising costs in this and this area. And suddenly they're knocking 50 grand off the house price in order to shift it. And when enough people are in enough of a bad situation that they start undercutting people to get the houses sold, guess what we get? And it's I'm not necessarily sure it's going to happen here, or when I say here, I think it's most likely to happen in China. China have a bad problem because they're say, for those who don't know, China's housing market is basically a functional Ponzi scheme, where many people, so sort of like individuals, families sometimes will band together and they will buy a house or they will buy an apartment. Now they will buy an apartment often in an apartment block that hasn't even been built yet. It's not been constructed. And the housing companies are using the money that they give their deposit, and they're using that money to complete the previous homes. And the idea being that as long as the house prices keep going up, people will buy these plots, and you can buy a plot and then you might even sell it after a year before nothing's even been built, but you'll make a profit on the plot. And despite all of this, you've got a situation where people are basically just trading housing derivatives. They're trading promises to build a house, but there's not enough money to build all these houses, especially if the house prices start to go down. And if you're in a world of tightening credit, of a reducing affordability of loans, how do you maintain and fuel a market which only works as long as house prices continue to go up?
Yeah, it's not going to be fun. I mean, it's not going well for them right now over there. I mean,
no.
Yeah, it's. I mean, first we had the Evergrande thing, right, where people were freaking out and like they got bailed out.
I mean,
basically.
This is it.
Like,
people should have been way more scared of that than they actually were.
Because I was scared.
Because that was a domino falling, and it just so happened that domino, it just didn't really, it toppled and missed. But there were, it's in exactly the same way that we had Silicon Valley Bank in the US crack, when that collapsed, and was it Silvergate? That was $200 billion worth of, we can handle 200 billion. What happens when it's 5, 10, 15, 20, 50, 100 regional banks all starting to fall one after another because none of them have got any money to service their unaffordable loans?
Yeah.
And that's a situation, people obviously, rag on banks quite rightly for being, the industry that it is, but like it or not, they are a business that has to make money, and in this current financial environment, they can't really make money. It's ironic that charging record fees on credit cards, people think, oh yeah, they're just being greedy. They're not being greedy. They're scrambling for cash. This is this is where the problem lies in asset valuations that are up near all-time highs, where underneath, this is when people talk about tightening liquidity. It is a drying up of the available money in the system that's free to move about. And if there's not enough money available, those are the supports that hold this big asset market up. And if the supports aren't strong enough, the market, the whole market will fall until it's at a more fair valuation, or most likely it massively overshoots and becomes chronically undervalued. And it's a nice
a lot of stuff.
It's a prophet of doom scenario, and the problem with trying to predict it is every month that goes wrong, that it doesn't happen, you seem more and more and more dumb. But if you just follow, just say, the pure logical idea of how do you not have a recession when you are tightening up affordability of loans. So if in order to not have a recession, you need a constant expansion of credit. You need to generate growth, you need to be generating more loans. That's basically how growth works. More money, more economy, more, it's more loans. That's all it works. If you've got tightening credit and tightening availability of loans, how do you continue to grow the amount of loans? You can't.
No, you can't. Yeah, it's like this is one of the reasons why we want to do these Macro Tuesday things, because there's so much complex stuff to go over, and it's ever changing because a lot of things can happen in a week. Like in the macro perspective, you really tend to zoom out on like a monthly chart thing, because that's when measurements come in and all that. So looking at it day to day is not really going to give you much more than maybe a kind of a heads up what's going to happen next month, basically. But as an example, when they started raising the rates in the United States in March of 2022, I remember talking to Rob, and I said, should I lock my mortgage in at like 2.5% rather than 1.2 that it was currently being raised to? And looking at the Fed funds rate, the trend was that it wouldn't go higher than 2.5 without it crashing, and that was the trend, right? And I can actually show that just for the sake of showing what I mean. Give me 1 second. Here we go. So here's the Fed funds with a bunch of stuff on it. I'm gonna hide. No, I'm not. Well, it's this yellow trend line here. We saw this. This is all the way back in April of 1989, and then we had a peak over here in October 2020, and we had the same thing here. So you had a pause. They go down, had a pause. So you can see the trend is just like, it kind of didn't. The GDP would just kind of go to crap at this point, and they had to do it, which means it's indicating a weaker and weaker environment, across the cycles, basically. And my expectation was they would do the same thing again, and boy, oh boy, was I wrong. We're currently way beyond there, right? So the trend is now broken. It might not hold that much significance, the trend itself, but when you see this, your trend is your friend most of the time, right? And So I didn't lock in my rates, and right now I'm looking at a mortgage that has gone from $400 a month to $1,100 a month. And think of how many people did not lock in their rates. And this is what we've been talking about the whole time today, basically. People, generally speaking, cannot afford to do stuff anymore. And things are going bad, which is why I'm surprised at the GDP growth numbers of 4.9%. It could just be this quarter. Next quarter, we might see a massive dump. I don't know. But yeah. And we've already done this for 45 minutes. You still had some stuff left you wanted to go over, right?
Yeah. All kinds of stuff. I'm just literally just trying to find some stuff at the moment. I'm trying to look for something.
So okay, while you're doing that, I can just look at this, and I all these lines that I have here, the vertical lines. Basically, the first one has a measurement between when they started pausing to when they started dropping the rates in the past two, cycles of them doing this. So the top here for the pause was 365 days, was 12 bars, 12 months for this pause right here back in 2006, 2007. And then they had a 519 days where they were, lowering the rates back down. Over here during they kind of cut this one short because of, not because of COVID, because COVID kind of hit right after we were back to zero. But we had 181 days of pause and 275 days of going back down. And currently we are 2 bars into the 9-bar measurement that I just took an average of these two, which is not much to go off, to be honest. But, I had to do something, right? And I'll add, by the way, that the orange line right here, I don't know if you can see it, but this one right here, that is the month of the Bitcoin halving. So that's April 2024. And that hits a month after the Bitcoin halving. The average of the down, hikes going, or interest rates going down, possibly, will start happening. And it just makes sense to me, because it's funny how it kind of plays into the Bitcoin narrative, because the Feds, they have been talking about pausing until 2024, and then early 2024 they would maybe start pivoting back to go down again with the rates. And it's funny to me that it kind of just fits perfectly with the Bitcoin narrative of the halving happening and everybody thinking it's going to explode and everything. And if the interest rates start to go down, people will be, not instantly, but eventually they will start being able to spend money and borrow money again. And then that fits perfectly. The normies are going to start buying a very highly pumped Bitcoin. Meanwhile, the more experienced people will start selling into them, and then we get the Bitcoin cycle crash that we usually get, like a year and a half or 2 years after the halving.
It fits quite nicely, doesn't it?
It fits nicely. I just wanted to show that, because I forgot that I did these numbers or did these lines, and it just fits nicely for me. So I'm kind of happy to show it, actually. But look, I was wrong about the trend, so I might as well be wrong about this too, right? So there's that.
I think so. Okay, so the thing you've got to think is why did this trend happen? Like, why was that long downtrend in place? And essentially, this was a 30 year period where there was this tendency of this period of increased sort of money generation driven by economic growth. This economic growth increases money supply, because it increases, as I said before, it increases new loans. If people are going out and they're borrowing money and they can service that debt, then over time, the more debt they can service, the more loans they will create. That's how economies grow. That is just the reality of how the financial system worked. But as this affordability of this loan started to decrease, what that basically said was there was a limit a maximum amount whereby the economy was saying we can no longer handle interest rates this much higher than this. You're going to start causing problems, and you've got this 30-year trend of it going lower and lower and lower, and this is what's changed. What changed?
Yeah.
That meant that the fundamental limit on the interest rates has suddenly gone back up to what it was 15 years ago.
Yeah.
We've got massively higher debt, massively higher deficits. We've got massively overinflated. We've got continuous increase in stuff that is borrowed. Just a huge amount of borrowed money. And now all of that interest rate, all of that has to be paid back at higher interest rates than what you see there, because that's the minimum interest rate you're going to get. And this is what I mean. If you can get 5% on US government bonds, what interest rate is demanded on your car loan, on your house, on credit cards, on basically everything? You demand more interest on every other good. And the more interest that you have to charge, the less people can afford to pay for the actual item, or the fewer items you're going to sell because the marginal cost of buying that item has dropped off, and some people can no longer afford it.
Yeah.
And you cannot do what has been done without a recession ensuing at some point.
Yeah. And I mean, so people are wondering, like, well, what do we do? Basically, honestly, for me, I'm just looking at hard assets. Because people are talking about gold, right? Oh, we need to hold gold. Gold has lost value against the M2 money supply, which means it's actually you've lost purchasing power rather than lost dollars, right? Because if over time the dollar is losing purchasing power, inflation, things are getting more expensive. If you hold gold to kind of mitigate that, you're mitigating a lot of it, yes, but gold still has lost purchasing power in terms of dollars.
Can I just interject and say that the reason gold has lost purchasing power would apply to Bitcoin in a Bitcoin-centric world?
Yes, exactly. And that's what I was getting to, because Bitcoin has the same properties as gold, right? When enough people have, when the distribution of Bitcoin is as widespread as gold is, and when the market cap of Bitcoin is,
I hope it's going to be a lot wider spread than gold, because gold is very concentrated.
Yes. Because when you buy gold, you're buying paper gold. You're not buying gold bars and putting it in your pocket. That's just the reality of it.
And essentially, in a world of 0% interest rates, where anybody could get access to easy money whenever they wanted, and if you were rich, all you had to do was say, "Look, you see that million tons of gold that I own? Can I borrow several $1 billion against it?" And people look at it and go, yeah, sure. And that money was basically interest free. Then what are people going to buy with it? People were buying stocks, people are buying speculative things, stuff that goes up and up and up. A shiny yellow rock that's main property is it's really good at sitting in a room doing nothing
and not breaking.
Yeah, is not an exciting. It's not an exciting asset for that world.
It's funny how gold is just a piece of yellow metal that doesn't break. Yeah. That's essentially what it is.
Yeah. And it is absolutely fantastic at doing its job. It's the exact same job that Bitcoin does, sat on a ledger.
Yep.
But still, it's that this we're no longer in a period of easy money, and this is the kind of period where gold may actually start to really shine, as as like you say, you accumulating hard assets. Gold is one of those assets that has been chronically undervalued for a hell of a long time. And if people suddenly stop, if the trust in dollars starts to wobble, what is the next thing that they turn to? I'm sorry, it's not Bitcoin, it's gold.
Yeah, it's not Bitcoin yet.
It's not Bitcoin.
We'll put the yet on there
for a disappointingly long time. But also, it's going to be further away and sooner than people think.
Yeah. So anyway, I think we can round that off there actually, because we've been doing this for 55 minutes, and we promised to
didn't
keep
get round
under an
to
hour.
half our stuff.
Yeah, it's fine. There's another week
We'll
next
have
week.
to do it again next time.
Yeah, no. So we're planning on doing this every Tuesday, and you know, as we do this more often, we'll probably be better at kind of putting together our talking points so we don't stray too far, which I don't think we did that bad this time. But straying out of the we want to go wide on this one. This is the whole point. That's the whole point of macro. You go wide and deep. So I think that's that for today, right? Yeah, I'm gonna see if I can find the time to do a video on Thursday. That'll be a solo one, I believe, where I will try to do a how-to something. We'll see what it is.
Yeah.
How to do something. How to read how to make trend lines, whatever. We'll figure it out, because we're planning on getting that educational content onto the channel, saved in a playlist for everybody to be able to go through and kind of learn how to use the RSI or the Bollinger Bands, or how to make trend lines and engulfing candles here and there and all that stuff. So I'll get to that as soon as possible. Yeah, we'll see you when we see you. The worst case scenario, we see you on Monday next week, Tuesday, Monday. Worst case scenario. And we do need to. We're gonna put up a poll on. I think I'll do it on Twitter, either Twitter or sorry, X. or the Discord.
Gotta love that brand recognition, right?
Yeah. So we'll put up a poll to figure out the name for a segment that we might want to do on Fridays, which is going to be, I think the name suggestions were the Crypto Talks Twitter roast, post roast, or just
rolls right off the tongue, that one.
Yeah, something funny sounding, but we'll basically be roasting Twitter posts or X posts and seeing what we can find. We'll roast the bad ones.
I can't see that one becoming a regular feature, but we'll see.
Probably not, but we'll see. It's gonna be a fun one, I think. There's a lot of weird tweets out there, man, and I want to shout out the good ones, and I want to roast the bad ones. I'm a little bit too honest when I do that, maybe. So we'll see how much hate we'll get for that one, but it'll be fine. It'll be fine. Don't worry about it. Anyway, we'll round this off here, guys. Thanks for watching. Like, subscribe, tell all your friends, all that jazz. And join the Discord. And I'm gonna sit in the Discord after this and hang out for a while. So if anyone wants to hang out and chit chat a little bit, we'll be there. Okay, cool. Thanks. Bye.